Awesome. Cool. We are starting to record. Thanks for coming, everyone. We'll go ahead and get started as people trickle in. So this is a brown bag introduction to real estate investing. It will be about an hour long, and I will be doing most of the talking. We may have some time at the end for questions. So before we get started, a few disclaimers and notes. This is not investment advice. It's also not the only way of doing things. Whenever I say something doesn't work, it doesn't mean it will never work. There are 100 different ways of investing in real estate. This is just a sample size of one. I will be going over things fairly quickly, and so may not have much time left for questions. So if you have questions or personal questions, feel free to reach out to me privately afterwards. I might leave some time at the end for questions. I'll be monitoring the chat channel as well. So the agenda item is we will go over what is real estate investing, what are some of the returns like, what do you expect, why do you do real estate investing. We spend most of our time on the trade-offs between single family and multifamily, and as well as should you do in-state or out-of-state investing. We'll briefly touch on tax implications, and as well as some of the parting words, as well as the risks involved. Finally, I might do a sample demo of a underwriting spreadsheet or a analyzer to underwrite or to analyze a sample deal. Cool. So first, I'm Perry Zhang. I am an engineer manager at Lyft at the driver earnings team for 5 years. I gave my first real estate presentation back in February of 2016 to a room of data platform engineers when I was still on the data platform team. Since then, I have bought 7 single families in San Francisco and the Seattle areas. I am an operator / syndicator in 800 apartment complex units. Yes, and I passively invested in about 2,000 units. A few fun facts about me. I like credit card churning, just getting a lot of credit cards. I like playing poker, and I also live with 4 housemates in Seattle. People joke that things that I'm interested in all tied to money or making money. So what is real estate investing? Rahman, the rules for questions is you can put the chat in the chat. I may or may not get to it. Yeah, I most likely may not get to it, but the fact I have your questions is too helpful. Okay, cool. All right. So what is real estate investing? My form of real estate investing is investing in rental long-term hold properties. What you expect is 6 to 8% cash and cash return. This is kind of like dividends. This is the return before you sell your property. Now, if you include the sale of the property, you should be expecting 10 to 15% annualized return, including the cash and cash, i.e. doubling your money every 5 to 7 years. Now, the number one rule of real estate investing, in my opinion, is sacrifice. And this theme will permeate throughout the rest of this presentation. It is very much tied to your lifestyle, how you think about what you prioritize, and in order to have better returns, you kind of have to sacrifice parts of your lifestyle. And it is an investment, so it can lose money like any other investment. So why real estate investing? The number one reason is financial freedom. Personally, when I am 40 or 50, put a number in yourself, I don't have to work if I don't want to. I want to be able to take my kids to piano practice, soccer games, or anything I like. It's also about building net worth. There is this simple formula that people use to calculate how much net worth is required to maintain a stable yearly disposable income. So in this example, it requires $2.5 million to maintain about 100K of yearly expenses if you are the age of 40. Now you can plug in different numbers, and that 2.5 million might actually be a little bit higher now. Probably talk about $3 to $4 million because of the inflation. Now some people achieve it through stocks and startups. Other people achieve it through other means, such as real estate investing. Now my approach is the following. I buy a rental property. I do some repairs. I rent it out. I may or may not refinance, and then I repeat the whole process. There is a term called BRRRR. Some of you may have heard, which is that whole cycle. I buy rental properties. I don't flip them because flipping is a full-time job, whereas buying long-term is investment, in my opinion. Besides the single families, I will send out the slides afterwards. Yes, good question. Besides single families, you can also buy multi-families. That's 2 to 4 units, or you can do 10 plus units, or you can do 100 plus units. If you are serious about it, you will be putting in $2 to $3 million invested into real estate. And based on the previous slide, because of the 6 to 8% cash and cash return, that is about 120K to 240K of disposable income every year, just purely on the cash flow, not even the appreciation. I tend to invest in value add properties in emerging markets. That could be emerging cities or emerging neighborhoods. And I'll talk about both in a second. And then finally, you want to establish your competitive advantage. Now, my competitive advantage is that I am willing to live with housemates. The other competitive advantage, which is same as yours, is you probably have a high-paying income that looks really good to the lenders. Some of your other competitive advantages might include that you have relatives or friends in the area that you're trying to buy rental properties in. It could also be that you have a spouse that you can low balance the amount of work. Okay. It could also be that that you know how to do Airbnb and you're really good with the interior design. So figure out your competitive advantage. Okay. Now, when it comes to how, it is a business. It is super easy. At the end of the day, the whole point of the business is to increase rent, increase your the revenue, and lower expenses. So first, bring the rent up to market and figure out what is the market rent. That involves research. In terms of lowering expenses, you will things include sub-metering for the water, reducing the garbage, the sewage rates, reassessing the property tax, get the best insurance rates, etc. And you can also think outside of the box, such as creating an extra room, adding a bathroom, doing Airbnb, and so on. Now, the most important part of rental properties is property management. So it's important that you have a good system to screen, manage, and evict tenants if needed. And finally, depending on what kind of income you have and how long you have worked at your job, it's possible to get better financing options. Okay. Cool. All right, so we will be spending most of our time discussing some of the trade-offs. So what I recommend is if you are starting out, buy a single family first. It is easy to house hack because you will treat it as your primary residence. You probably are going to get the best loan terms from the bank with the lowest interest rate and probably the best leverage. And it is one way that you learn, and probably the best way to learn to be a landlord, right? The cons is after a few single family houses, the bank probably wouldn't lend you any more money. And so it's hard to scale and hard to retire out. The pros of multifamily is this is the only way to scale, and Multifamily is also a feel-good business where you are responsible for the living condition and the livelihood of hundreds of tenants living on your property. The con of multifamily is it has a high barrier to entry in terms of both experience and in terms of capital. There's a question about what is house hack. A house hack is that you buy a house with 4 rooms, you live in one of the rooms, and you rent out the other 3 rooms. That's a single family house hack. The other way house hack can also be used that when you buy a duplex, you live on one side of the duplex and you rent out the other side of the duplex. The third way, it's a very loose term. Another way of house hack is you buy a duplex, you live on one side of the duplex, and you Airbnb the other side. Again, as you can see, the number 1 rule of real estate investing is making sacrifice. There is a lot of potential in what you already have. It's up to you if you want to make the extra $1,000 to $2,000 of income and learn what does it mean and how or what kind of work it takes in the process. Okay. Now, between in-state investing versus out-of-state investing, in here, in-state, I actually mean just investing in your neighborhood within a 1-hour radius, driving radius. I recommend that you start with in-state. If you live in the Bay Area, that there is an exception. I'll talk about that in the next slide. The pro of investing in your neighborhood is what you see is what you get. You know exactly what's happening in this neighborhood because you are part of it. You have easy access to the property, and it provides the highest chance of success. And that's the only way you really get to see what does being a landlord feel like. Okay? Now, if you don't have an option, you can look into out-of-state. The pros of out-of-state is it's cheaper and it provides a lower barrier of entry. Down payments in the Bay Area could be as high as $600,000 or more. Down payments in out-of-state could be 100 to 150K or sometimes much, much less. The con of out-of-state is that it's usually not worth it unless you buy at least 5 to 6 properties in that area. It's common sense, but when you have an out-of-state property, you will rely on the property management company who has many, many clients, some of which may have 50 properties with the same property management company, and you only have 1. So when something goes bad, what do you think, whom do you think the property management company will prioritize? So you usually don't have much leverage. And if you want to change anything, it might require you to fly out to that neighborhood or to that market to check on the property. And that one flight will wipe out the next 2 months of cash flow. So I do not recommend that you buy out of state just because it's cheap. So what do I recommend? If you don't live in the Bay Area, buy something within a 1-hour radius. So for example, people have asked me, I live in Seattle, should I buy in Portland where the cash flow is better? Or should I buy within Seattle or some neighborhood of Seattle? And I always recommend that you buy within the 1-hour radius because it makes you more willing to get there and keep a pulse on the property. Now, if you live in the Bay Area, you're kind of out of luck. Consider moving. I moved from the Bay Area to Seattle because of the no state income tax and because real estate is more affordable here. Again, sacrifice. You can consider doing Airbnb, consider doing house hacking, and renting out by the rooms. If you buy in Sacramento, you might as well go out of state. That's my opinion, because investing in Sacramento versus investing in Austin is kind of the same. Okay? Because if it's 2+ hours, just get on the plane and get there. Now, these are all kinds of priority queue, but if all fails, focus on buying your first primary residence, then focus on the first rental. So what I mean is, If you couldn't buy anything within the Bay Area, don't let that be the excuse that you're not gonna buy anything. Even if it's out of state, in the Midwest, just buy one, build it out. You're not gonna lose that much money, and I think you're probably gonna break even if you screw up, but it's going to teach you a lot of experience and lessons. Okay? If you do invest out of state, what markets would I recommend? Here are the 3 types of markets that I can put them into boxes. The first type of market is high appreciation, but it has negative to low cash flow. These markets will be San Francisco, Seattle, New York City, and maybe Austin. The second type of market is median appreciation and median cash flow. This will include Dallas, Atlanta, Houston, and also probably Austin. And then the last type is low appreciation and high cash flow. This will be Midwest and maybe Oklahoma City. Okay? Now, I buy single families in high appreciating areas because I believe that those are intrinsically good areas, and I will still want to live in them. I buy multifamilies in median appreciating areas, such as Dallas. And when it comes to multifamily, I do pick the landlord-friendly states. Okay? I'll get to some of the questions maybe at the end, just so that we can finish all the slides. All right. The other question I get a lot is, should we buy now? Is this the top of the market? And what if the market goes down? This is the contrarian view. I don't believe in when is the best time to buy. Focus on the craft, not where in the market cycle we are. The example I tend to give to people is, if you are a software engineer or a product manager or any job at Lyft, you probably are not worried about a tech downturn. Even if you are, you probably will get a job within 6 weeks. Real estate is an industry, but there are levels to it. If you are the best real estate investor or one of the best operators, most likely you're gonna be fine. And the other thing I do is, I started about 6 years ago, and now I have 7 single families. So I buy a house every year. So do that. Dollar cost average out. Now you can say, well, I don't have that much capital. That's true. We can talk about that as well. To give you an example, in our latest real estate transaction, we got a 0.5 brokerage fee, a loan brokerage fee instead of 1%, saving us more than $80,000 because it's a humongous loan. Our cabinets for multifamily were imported directly from China. So we're paying them 80 cents on the dollar. We have the lowest cost and the most reliable contractors that do our renovation, because we have already filtered out the ones that are not reliable and not the most affordable. And with every vendor, we pretty much get the best deal. So if I can do everything 80 cents on the dollar, I don't mind paying a little bit higher. The goal is not to maximize globally by timing the market. The goal is to maximize locally, so that even if the entire, for example, Dallas market gets screwed, you are one of the least screwed among the screwed. That's my view. Okay. The other question people also ask, like, what happened with COVID? How did you deal with COVID? During the time in which the stocks went way down last year, it's as if nothing happened in my life. Everyone still paid it on time. Now, I got lucky, I think, because we had a right system of screening our tenants, and the rents were way under market, very, very, very fair. So they were able to pay it. And my tenants were also have good jobs, and so pass the income and the credit score. So nobody skipped a payment in all my single families in Seattle. So if you have the right system in place, you don't really worry about if this is the right time to buy. Now, is this a worse time to buy than 2 years ago? Yes. And so yes, be careful, but you cannot time the market. All right, toward the end, I'll talk about tax implications. So I'm not a CPA, so please consult your CPA on this. What I will say is real estate is a government subsidized investment. It is kind of ridiculous and stupid. If you invest in real estate, chances are you will never pay tax on that real estate investment, almost indefinitely. It is unfair, it is stupid, but it is just the way it is. The way you look at it is real estate is almost its own ledger. So all the passive gains and the losses in your real estate sum up to a single number. And so what you do is to invest in a big apartment complex, for example, you already have paper losses. Every year you get cash flow, which will be capital gains or passive gains, and that they kind of keeps deducting the passive losses that's on paper. When you sell the property, you have this humongous gain, which then you have to pay taxes on. But if you, at that year in which you sell, you reinvest or not reinvest, put new fresh equity to buy another apartment or another house, then you can further, you have new capital losses, which will then end up wiping out all your gains. So it's called the rat race of real estate investing. By continuously investing higher amounts into real estate and indefinitely postponing the tax. You can never not pay tax, you can only postpone tax. This particular thing is not really 1031 exchange for people asking. It's just depreciation and passive gains. Consult with your CPA. It's a whole topic on its own. Now, one important thing to realize is that those gains or losses cannot offset your W-2 and stocks, especially if you are a non-real estate professional. And pretty much all of us here are non-real estate professionals. Okay? If you are a real estate professional, it gets even more unfair that it can offset your active income. Consult with your CPA. But if you are a engineer at Lyft and your spouse is a real estate professional, then it can all your real estate activity can offset your W-2 as well. Okay. Now, you can call it unfair and whatnot, but it actually kind of works. For example, on my first property, we sold it. I got this huge amount of payback, and now in order to avoid 10 to 15% tax that I have to pay, I am incentivized to put all of the money back into real estate. So effectively, I still don't have that much cash. So it's kind of like credit card points. It works because everyone is trying to save the penny and putting it back into real estate. Okay. All right. Last one. I want to talk about what makes real estate investing hard. The first one is it requires gut. You have high upfront monetary commitment, and you must have the means. Okay, it requires a quite upfront high down payment. Okay. Second is communication. It's a people's business, and it is important that you learn how to influence others. Especially with single family, you have to influence the maintenance folks, the property management company, the brokers, lenders, vendors. In multifamily, you actually influence the property management company, who then influence the on-site manager, who then influence the lead maintenance folk. So it's a lot of leadership skills involved. Emotional resilience. Real estate investing is hard because you might be dealing with a roller coaster, and you are making bets that you don't see results for many, many years. The hardest part might be the grind. You have to deal with day-to-day maintenance, paperwork, tax returns. I hate tax returns. I still have not finished my tax returns for last year. I've been waiting until October every year for the last 3 years. Delayed gratification. And that usually roots out like 95% of the population. And finally, analytical skills. This includes learning how to understand and create spreadsheets, numbers, evaluate different loan options, interest rates, APR, IRR, cash and cash. There are some numbers involved. What I found though is some of my smartest friends are very good with the analytical skills, but they're usually, I have a saying that people could be too smart for real estate. And that's probably a true statement, that because they're so good, they don't really need to wait that long to see amazing returns. So they tend to be drawn to things that have high cycle of reward. I don't feel that I'm particularly smart or like super genius, and so that's why I chose real estate. Okay. And then the last thing I want to mention is most people have maybe 3, 2, or 4 out of the 5, but it's kind of hard to get someone to have all these 5 attributes. And you don't need all of them. Some of them you can develop. Okay, so some risks and parting words before I get to some of the questions, as well as doing a quick underwriting analyzer. So first is there's an upper limit on how many single families you can buy before the lenders no longer want to lend it to you. The limit is usually 8 to 10 properties, and it could be less if you are in Bay Area and Seattle. Now, real estate is an asset class that's not liquid, okay? And people have before say, I don't want something that's not that's in liquid because I want to be able to sell and whatnot. Here's my comment and kind of like my generalization. There's usually a 30% premium to liquidity, which means that if you want something that's liquid, you probably should be making about 30% less than if it's not liquid. There is a premium to liquidity. And I believe that generational wealth does not come from something that's liquid. If I give you $3 million in the bank, the first thing you probably will do will put some of them on the side and make it in liquid so that you don't touch it. And yeah. The next point is try to decouple making money from enjoying life. I have been a very frugal person all my life. I could technically live anywhere I want, but I still live in an up-and-coming neighborhood in Seattle and not live in the downtown or anything. I still have housemates because I don't know, I like this kind of seeing my balance sheet grow. Like that drives me. But I also been told that there's a point in which you should put your foot off the gas pedal a little bit. And for some of you, that could mean, I'm trying to buy my first primary residence. Should I buy a $3 million house that I really, really got to enjoy? Or should I buy a $800,000 townhouse that I like? It's not the most shiny thing, but it definitely lowers my monthly expenses. I would say, don't try to couple making money from enjoying life. Make it clear in your head whether this is to make money or this is to enjoy your lifestyle. Yeah. So one day I will buy maybe a condo or a house. I will just splurge a little bit in downtown Bellevue. But now I just still couldn't find the gut to do it. The next point is very interesting. Banks are smart. Banks are smart because they are basically an insurance company. And you can tell that because when you apply to get primary residence, the interest rate is like 2.975%. If you try to ask a hard money lender to lend you money to do a fixer upper, it's 12% interest rate. Banks are smart because the interest rate is inversely proportional to how risky that asset is. So whenever you see a deal when the interest rate is so low, it probably means that the bank has given an implicit nod of approval that this is a low risk asset. I hope that makes sense. And then the last one is everyone here actually has something really important, a competitive advantage, which is that they have a W-2 job. W-2 job is like the best thing to a lender. Try to get a loan when you don't have a W-2 job and when you have your own business. So don't quit your job yet, just to focus on real estate full time. And I also heard that if you're not willing to do real estate on the side while you're having a W-2 job, then you're not passionate about it enough that it probably wouldn't really work. So these are my parting thoughts. All right. Some of these are references. So I'll do a single family spreadsheet, a multi-family spreadsheet. The books, in case you're interested, the one book that I like is the book on rental property investing by Brendan Turner, also managing rental property, as well as the Rich Dad Poor Dad. Rich Dad Poor Dad has questionable sensationalism, but when I first read it, I still like it a lot. When I started learning about real estate, I listened to the Bigger Pockets podcast a lot, and you can fill out the survey at the end here. When you fill out the survey, I will just ask for your email and first name, last name. It's up to you, totally optional, in case you want to keep in touch. So now, let me go to some of the questions since we have 25 minutes left. All right, cool. One of them is, do you recommend investing in opportunity zones? And what are your thoughts about qualified opportunity zones? Great question. So I don't know much about opportunity zones, so I actually don't know. But in my opinion, I don't think you should really invest in something to save on taxes. Okay? Okay? And so I don't know, and I'm not very bullish on it myself. Okay? To qualify, is that generally better to find a way to be categorized as real estate professional if you can make it happen? Yes, but it will require a lot of effort. So yes, yeah, okay. Any tips for vetting property management companies? Suppose I want to optimize for tenant happiness, but also ensure that the money is spent wisely on repairs and maintenance. The best way to hire a property management company is to keep firing the ones that you don't like. Personally, because of the number of units I have, my dream is to create my own property management company. So, but in the meantime, yeah, there's no good property management company in the world. It's a low margin business, so they're not making that much money either. Okay. Thought on flat rate property management company startups, those who don't take a % of the risk. I will tell you that most likely it doesn't work because it's a low margin business. So the quality of people you're gonna get will probably not be very good. Do you use a real estate agent? Yes. Even though I am a real estate broker myself, I still use a real estate agent. They are good in what they do. They can negotiate. They can do better, way better than me, even though I'm a real estate broker. I only use my license to buy my own deals. A good real estate broker is worth the go. What locations do you have your properties? I think I answered that. It is in high appreciating areas for single families and median cash flow and median appreciation for multi-families. Okay. When did I start? Was it after the house started in 2015 to 2016? So one thing I do want to mention is I am lucky. I never seen a recession really besides the 2020 temporary dip. So yeah, like when I first started, I was putting down 10%, 15% down payment instead of 20%. So yes, I could have been very, very screwed at this point if there was a crash. So there's a lot of tailwind involved. Before I answer more questions, I actually want to stop here and do a analysis on the single family. So this is a house that is currently on the market, and I am actually buying it. So this is a real life example. Okay. It is in Plano, Texas. This is my single family. This is my first single family outside of Seattle. And before you say, oh my God, this is why you buy in Texas. Yes, you can buy a mansion with $750,000 in Texas. So it's a gorgeous property, 4,000 square feet. Yes, you don't see those prices in Seattle, and that's why I like it. Now, if you rent this out, it probably rents for about $3,000, $3,500 at most, and you probably gotta break even or maybe a little bit of negative cash flow. So I have a spreadsheet that calculates how I should, what's my business plan with the property. So I'm purchasing it for $750, even though it was listed for $725. I'm gonna put in $20K of repairs and maintenance as well as all the furnitures. And I'm going to use it to do Airbnb. I will put down 23% down payment because the conforming loan in Texas is $580-something thousand. So that is the maximum loan that I can take out. Now, the interest rate is very, right now I put a pretty low interest rate here, but it could be as high as 4.125, okay? All right, so let me actually do the lower one. The gross rent, this is why it requires work. I will go on Airbnb and do a search on how much this Airbnb can rent for per month. So I type in Plano, this is the area, my house is over here. And you can see a nice 4-bedroom, 5-bedroom can rent out anywhere between $6,000 to $7,500. So I want to be a little bit aggressive and say it's for $6,500 a month in terms of Airbnb. And instead of 5% vacancy, I will put down 15% vacancy. So this is all just like math, right? I also over budget the taxes as $900 property tax as $900 per month. Here you see the property tax. If you see here, it's about $874 according to Redfin. So that makes sense. Insurance about $100 per month. CapEx, utilities, and so on and so forth. So what is the result? The result is that I have about $500 in cash flow per month, right? And my cash and cash return is about 3%, which is hella low, right? Yeah, so this is really, really low. All right, let me actually take a look at the question before I go on. Okay, I'll answer those in a bit, okay? And what's also really, really interesting is that if you look at the return, the annualized return over the course of 5 years is 11%. This is annualized return. And if you hold it long enough for 10 years, it's about 13% return. And then if you hold it for 30 years, it's about 10%. So my rule of thumb between 10 to 15% is a good number. Right? You should not expect any more. If you try to do something like that for your own property or for something you're trying to buy, and you'll see that it's somewhere between 10 to 15%. Now, another thing which is really interesting, I'll show you is let's suppose that this property doesn't appreciate at all after 30 years. So yes, if it doesn't appreciate, then you gotta break even in the course of 5 years. You gotta make some more money in the course of 7 years, and in the course of 30 years, you still gotta make an 8% return. Is that a good number for all the work that you have done? It's okay number, and this shows that in the long run, you cannot really lose in real estate, right? Obviously, there are some other assumptions like, assuming the rent will increase by 2% and the expense increase by 2%, but that's just inflation, right? Yeah, so that gives you an example of, yes, that's why there's a saying that in real estate, you can't really lose if you hold it long enough. So prices are eventually consistent, and you just have to hold it long enough. And so again, generational wealth doesn't get made when the money is liquid. All right, go to some of the questions. Would you recommend forming an LLC for all your properties? Yes, I do recommend. However, initially for some of my single families, they are still held under my personal name. Now, this is really bad, I know, but I'm one of those people that is really lazy when setting up the right illegal entities. So everyone has strengths and weaknesses. And yes, you should, but I have not done it. So yes. And a lot of times I'm buying them as a primary residence. Not this one, but so if you buy a primary residence, when you switch to LLC, make sure you give the insurance company a call that you are still under name. Otherwise, they will say, oh, the LLC is the one that's insured. You're the one who's insured, but the title of the property is the LLC. So technically, if something happens, I should not insure it. Okay. There was another question. If you're willing to share, what is your overall investment portfolio allocation over time in terms of stock versus real estate? Did you have to liquidate stock investment to buy your first few properties? My allocation is about 70% real estate and 30% stocks. And I have constantly moved things from stocks to real estate. Now, in some of the large apartment complexes we bought, there was a big dip when I tried to sell the stocks. I sold it anyway to buy the apartment complex. So yes, that hurt. But well, guess what? 2 years later, these 10 to 15% is future projection. The last 2 years, actual performance of real estate is, in my case, was like 30 to 40 or 50% annualized return per year. So even if you compare apples to apples, my performance in real estate has been better than my performance in stocks. When I say 10 to 15%, it's all about going into the future. So it will not be fair to compare like, oh, real estate only gets you 10% return, and then stocks gets you like 30% return. Well, if you really want to compare historical performance, real estate still wins. But don't expect that. Don't expect that at all. What's the typical time to rental for new investor after closing? How many months? So this is a great question. My answer is less than 2 weeks, because you should be posting on Craigslist technically before closing. And sometimes I will even post it before I purchase the property, just to see how much demand there is. There's a lot of stuff you can do, and that's why it's work. And what maintenance costs do you incur? So one question here is what maintenance costs? This will be my maintenance cost, right? This is actually lower than it should be, to be honest. And so this one, maybe CapEx should be more like $1. So this will lower my cash and cash, but that's fine. This is a trophy property that still kind of doesn't lose money anyway. So I'm fine with that. Okay. If you are doing rental properties, is it not better to buy with cash mortgage to avoid paying interest? So always take out a loan. That's my opinion, because you're paying about 4% interest. And as long as your projected return is higher than your interest rate, you're basically taking the arbitrage. Now, excessive leverage is really bad, and you could get into huge trouble if you take out too much loan. And so, yes, it's a act balance. It's an art. Okay. All right. I think that answered a lot of questions. What mistakes did you make on your first few properties, and what did you learn from them? I make there are too many mistakes to name. One is not having the right property management company. That's probably one. Underestimating the amount of CapEx it takes. So underestimating your costs. Underestimating the amount of work it takes, especially with tax and like tenant relations, people like not happy. And then finally, just every real estate that you bought, it's a time bomb, right? And it's possible that all of your properties like go underwater at the same time. And so just be careful. All of them is a time bomb waiting to go off. So yeah, do be careful. And so there is quite a bit of pressure of worrying if any of the properties is going to survive. Now, that hasn't been the case because we're in a bull market, but I fully understand that going forward, that it may not be as smooth as it is right now. Okay. All right. Maybe I have maybe some questions that you can ask in person, so that I can hear some of you talk. By the way, is this helpful? What other questions that folks have? Yes, I will open up the queue. Go ahead, Jetty. Go ahead.
Hello?
We can hear you. Awesome.
Okay, sorry about that. So my biggest question is regarding like multifamily homes. So when we were looking, I've done some research in the Seattle area up to like Yakima, and it seems that also like the multifamily homes are like very old and probably don't seem appealing to like people who want to rent homes. So have you ended up like ever like contracting companies to build new homes or trying to find new homes by a builder?
Yeah, good question. This is kind of like an art. I almost always buy new houses or houses that are built after 2000. And my feeling is that when you buy a new construction, you're usually buying it from the builder. And the builder usually had to build 5 to 10 houses at a time. So supply and demand dictates they're really wanting to sell and wanting to negotiate good price with you. When you buy a new house, there's almost no capex, there's almost no maintenance, and so you end up winning by buying a new house. You will never buy a new car, but buying a new house is actually not a bad idea. So, Yakima may be an exception, but in Seattle, I actually buy new construction townhouse. I don't mind buying them, especially using the using it for Airbnb. I can only have 1 or 2 Airbnbs in Seattle, so that's a problem. In Yakima, it could be that there's no new construction going on. So in that case, you have to wait. The cap that you spend to get contractors to renovate it versus that if you just pay for the finished product because you can have a high leverage with the bank. That's a trade-off. And I will say you don't have to do the renovation in your first single family. Just use the bank, pay the finished product. It's okay. Well, because guess what? When you try to do a renovation and it's your first time doing it, you're probably gonna pay retail price anyway. Hiring contractor to do the work doesn't always mean it's gonna be cheaper than just leveraging the bank to buy a finished product. Yeah. Okay. Next question. Open the line. Okay. Nish. I think first to last. Okay. Nisha. Go ahead.
Hey, thanks. Thanks so much for making the time to do this. My questions are less technical and I guess more on the, I feel like you're someone who's an observer of this market and what it takes, as well as someone who does it. And I'm curious about, you had one slide about what are the key skills to be a great real estate operator. I'd love to hear a little bit more about like soft skills versus modeling, who you've seen of your contemporaries who like do well, who don't do well. I can tell you one thing in listening to you that like, I don't feel like I have that grinder mindset to like, to really suffer for the profits in the way that you seem to be, which I really admire.
It's a good point. I think that's a good point. I think one way is that you should know these people who are really good in real estate, and then perhaps build a relationship with them and invest with them. Because when I don't want to mention it in this brown bag, but like there are people that do real estate for full time, and because of their skill set, they're able to raise money to invest in a large apartment complex, right? So know these people, and those passive investments are actually really good returns as well. Now, I always tell people though that it's important that you buy one property to see how hard it is, and then you can appreciate how easy it is to invest with a good syndicator. And second, Like some of this is you kind of figure out on your own. Like I don't think I was good with communication. I don't think I was good with emotional resilience. But like you got better over time. And the more things you know, the more confident you are about, okay, I've seen this before, I haven't seen this before. Okay, so there's that. I know that's not a perfect answer, but I think these could be taught. These are not innate at all. Yeah. Cool. Next one, Tarun. Oh, Tarun, you are probably muted. So for those people. Oh, sorry. Go ahead. Go ahead.
Oh yeah, sorry. Thanks, Barry, for doing this. Super helpful. First question was around HOA. Do you recommend investing in condos which have some HOA to take off headache on maintenance? Okay, you're paying $300-400, but you're really like offloading a lot of maintenance to the HOA and building. And second question was, why do you use Airbnbs instead of long-term leases like one-year leases?
Great question. All right, let me mute you. Okay. I don't like HOAs at all. I have one condo in San Francisco and I sold it. And that's probably the best decision I have made. The reason is HOAs only get more expensive. They restrict you to do certain things. You own the air and you don't own the land. The property bill always depreciates because materials deteriorate. But what always increases in value is the land. Never own the air, own the land. And so from this point on, I almost always buy houses. I have not bought a single condo since my first transaction. And I got lucky on that first transaction because the market was going up. Okay. Now, if you buy a condo and you have a condo as your primary residence, don't worry. That's just, you can treat it as that's your enjoyment of life. And that's a lifestyle choice you made. It's not for investment. Okay. The next one is the other question. Actually, could you repeat the second question? It's a good question. I just forgot.
Yeah, the second question was, you mentioned Airbnb a few times to benchmark and instead of using long leases.
Yeah. If I can use long-term leases, I will do long-term leases. It's just that in prime locations, Airbnb has better cash flow. So in this particular case, I go to Dallas a lot. So if it's a long-term lease, I couldn't really live in it, right? But if it's Airbnb, is if I'm not in Texas, I will Airbnb it out. So this one, it just gives me more flexibility. If I have something in downtown Seattle, I usually will Airbnb it because it has better cash flow. I hope that answered the question. There was a question about whether these spreadsheets and slides will be available. Yes, they will be. And I will actually send out an email to everyone who's on the invite with a link to the spreadsheet as well as the survey. So if you can, we can fill out the survey. I'll just put this survey here. Okay. I'll put it over here in case people want to fill it out. Okay, cool. I hope you can get access to it. Okay, let's see. All right, next question. I know we only have 3 minutes, so I will be cautious, be mindful of time. The next question is Ashutosh. Go.
Hey Perry, thanks for doing this. My question, like what I've heard from friends that real estate takes a lot of time. So what tips do you have to like sort of manage your time as you're scaling up? Like for example, if you buy one property, 2 properties, 3 properties, like how do you scale up your team? Like do you do everything by yourself initially and then afterwards hire somebody else? Like how do you build that sort of a team?
You always try to do everything yourself so that you learn what does it feel like and what does it take. It's a lot very similar to career progression at any corporate job. So I had 4 rental properties, and I was managing 20 tenants myself at one point. It's not until 2020 that I handed off to a property management company, and I pay about $1,500 a month for the property management company to handle everything. Now that property management company and I are longtime friends, so I know they will do a decent job. And after I hand it off, $1,500 is the property management fee, but the opportunity cost is probably another additional $1,000 because nobody will do it better than you can. Nobody will care about your property the way you care. So first property, definitely try to do it yourself and see if you like it. And most likely is you may not like it, and then you think about what you want to do next. But if you do like it, you're gonna like it for a long time. Okay, all right, Aman, thank you.
Hey, Perry, thanks so much for doing this presentation. This is fascinating. I was wondering if you had any thoughts on, so, it's quite clear that you have to spend a lot of your time to kind of make this work, and you have to make sacrifices, and it's also quite clear you really enjoy doing this. But for an average person that might not have the same love, like how would you compare maybe investing in S&P 500 and taking that time and investing it in career and generating wealth that way versus kind of doing this as like another job?
That's a great question. I think I remember in the first presentations, I said the same thing. I am obsessed about it. There was one example. I said I will be driving, and I will say, okay, if I do some repairs, and that can be depreciated or write off on my tax, and my marginal rate is 33%, so everything I do will be like 25% depreciable, like some number like that. And I just I enjoy doing that math in my head while I'm driving and like looking around things. And so it does take a certain type of personality, I feel like. But if you don't want to do it and you're interested, say, in stocks and S&P, I feel like that's actually better. So yeah, I don't know much about stocks because I feel like I don't have control over them. But honestly, that could be better for the average person. Yeah, or you can find really good real estate operators that you can invest money with. That's another way. Yeah. So, yeah. But yeah, don't feel bad if you don't want to do this. That's why people have not gotten started, because it's a lot of upfront costs and very little reward for the first year. Right. I think that's pretty much it. That's all the questions. I think I also out of time. Thank you so much for coming. I really appreciate it. I will send out the survey, so I'll get your email if you want to keep in touch, and I will send out the slides and as well as the spreadsheets. The multifamily spreadsheet is even more complicated, but we don't want to go into that right now. Okay. All right. Thank you. Thanks everyone. Bye bye. Yes, I can drop the slides here. 1 second. The slides will be here. He has links to the spreadsheets at the end. Thank you, everyone.